This is Street Signals, a weekly conversation about markets and macro, brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. As the current turmoil in the Middle East enters its third week, the higher order impacts on the global economy and financial markets are all still very unclear. You have to say that despite the near complete closure of a key choke point in the global energy supply chain, markets do look remarkably resilient. But skittishness is obvious and understandable. Recent vol events have typically proven to be buying opportunities, so the desire to reduce risk-taking is low still. And volatility so far has been limited relative to these past events, perhaps because of this reticence to reduce risk. But it also means that no one has yet really experienced the pain of a proper VAR shock that actually forces de-risking. And as our guest this week points out, there's really no roadmap here. The best and worst case scenarios still have to be considered as equally likely, and the implications for how policymakers and financial markets will therefore respond is still very much up in the air. Lee Farage, head of macro strategy in the Americas for State Street Markets, joins me for a discussion on how we might expect positioning to further shift in response to this latest upset in geopolitics.
Hello, mate.
Lee, welcome back. I was thinking about this last week, and we started the conversation last week's episode talking about how unique this particular conflict felt in market terms. And I wanted to get your take on this. You've worked in markets as long as I have, maybe even a little bit longer.
Maybe.
Maybe just a bit. I'm curious how you're thinking about this and how you're contextualizing this as far as all the things you've seen throughout your career. What comparisons are you making to previous episodes? What extrapolations as well should we not get caught up in your view?
It is different in so much as this is very much, I think, a slow burner. We haven't had that big one day. You think back to, COVID or Lehman or even .com, the Swiss peg going, the collapse in the yen in late 98, that one day where it's just carnage. We haven't had that. This is this slow burn and it's sort of, everyone's nervous, everyone's watching it, but stocks are only, the S&P is only 5% off its highs. NASDAQ, is 8% off, but that high was in late October. This isn't all the move we're seeing because of what's going on in Iran. So it's not that similar, but the closest in some ways is probably the financial crisis, in so much as there were a series of things that happened and then Lehman happened and that was sort of like signaled towards the end of the financial crisis. But you think it was 18 months before that where it started, and we sort of, stocks only reached it hit a high in October of 2007, but the Fed did the emergency cut in August 2007. So it was one of those where it kept going on. I don't think this is going to go on for that length of time, but my point is, it's not a single one day, SVB being another one where you could point to, or Liberation Day. This isn't the same as that. This is one where we don't know the scenarios. We don't know how long it's going to go. We don't know whether oil in a month's time is going to be $80 or $150. And we're sort of stuck in it. It's almost in a limbo right now, I think.
Going back again to what we were chatting about with Elliot Hentoff last week, he made the point, I thought it was a really good one. The Iraq War I brought up as a potential point of comparison, just in terms of the conflict and the expectation that this might actually be quite short-lived. But he also then pointed out, well, with that conflict, obviously it wasn't short-lived, but the market effect was. It was all basically priced within, let's say, 3 weeks to a month. And I remember and I recall there was pricing for it because it was so well telegraphed. That, again, not like this episode. It was very well telegraphed, the kind of march to war. And I guess my next question then is, in that kind of scenario you've laid out, where this is just a kind of a dragged out series of events, maybe it won't actually have a big inciting incident for market volatility. Would you say we're closer to the end of the fear premium being priced in? Are we only at the beginning? I mean, I don't know is a very fair answer given what you've just said, but what is your sense in terms of how much further pricing we can get for this?
I don't know is the correct answer. I'm not a military strategist, nor are you. I know at times like this, we're expected to be military strategists. We're not. I don't know whether we can reopen the strait, whether there'll be a negotiated agreement. None of us know. What we do know is where investor sentiment is. And if I look at our behavioral risk scorecard, yeah, sentiment is negative, but it's by no means panic or capitulation. Yes, we've spent most of the period since Liberation Day in positive territory, so it's a bit of a surprise that we're negative, but there's no sign of panic. So, in terms of the question, are we at peak fear or anything else? No, not really. We're at limbo. Again, we've got this thing going on that none of us really know how it will play out, and so investors are cautious, but they're not factoring in the worst case scenario yet. And I think that's what we can say with certainty. We don't know how it will play out, but we know where we sit right now. And where we sit right now is investors going, oh, okay, not really sure about this, but I'm not going to take risk off the table in a large degree when the outcome is so uncertain.
If I were a management consultant, this is the point at which I'd use the phrase, let's double click on that a little bit and let's explore a little further. I wanted to think about the investor sentiment and also the positioning metrics that you mentioned and the fact that sentiment is negative but not capitulation. I wanted to ask what that might look like. Where in our investor holdings, where in investor flows, do you think the most or the greatest potential for further risk reduction is at this point? And also, part two of that question is how far do you see it going, whether it's just reducing risks back to benchmark or actually taking active underweight risk?
Well, I think the most obvious place, if we're going to drill it down, is in the asset class weight series, our series, showing how much of portfolios are in equities, how much in fixed income, how much in cash. And we have been highlighting for a while the meaningful overweight in equity allocations relative to fixed income. So, last week, pretty much we reached 30% overweight, equities over fixed income. So the average for that is 20%. You think of a 60-40 portfolio. 30 doesn't sound that far away. So it's 65-35. But actually, that's the biggest equity overweight relative to fixed income that we've seen since 2007, which is never a date you want cropping up in any of this stuff. So that's the bit where if we do see the capitulation, you've got to see that move out of equities, not necessarily to fixed income, but into cash, I think, and cash holdings are pretty much around neutral. I was having this debate with somebody just a minute ago about why aren't we seeing treasuries being the safe haven? Because you're only getting 4.25, 4.2% in 10 years. I'm getting 365 in cash. When you worry about fiscal implications, you worry about inflation, which the market is right now. Why wouldn't I just go into cash rather than chase that 60 basis points? And I think that's the most likely way you see this playing out. If you do get the equity capitulation, people move more into cash. It's funny because we were looking at this equity fixed income overweight in the context of whether AI was a bubble, the conversation a month ago, are we in a bubble about valuations, etc. And a number of clients, when I talked to them about this, pointed out the chart I have in my deck on this. If you look back to .com, that equity overweight was around 35 to 40%. So we were nowhere near that, but we were at 2007 levels. So it's worrying enough that you have to notice it. You have to think about that. And that's where you're really going to see the change in positioning. And then the other place you see it is the dollar, because we have had this big underweight in the dollar since basically just before Liberation Day. We got to the point where it was the biggest underweight since 2021. And that underweight is, we've seen dollar buying over the last 2 weeks, but that underweight is still significant. So that's the other place. If you're going to bring it back to FX markets, it's the dollar positioning. And the second part of your question, could we go underweight? It's a long way to go to get back to benchmark, quite honestly, right now. I'm not convinced by the time we get to the point where maybe we're back at neutral in terms of positioning, I'm not sure we will go hugely underweight. Look, again, there's a long enough way to go to get back to neutral before we have to worry about whether they'll go beyond that.
And actually, that brings up a sidebar I wanted to ask you. You mentioned client conversations and what they've noticed in what you've presented to them. And I'm just curious, this conflict is now 3 weeks in. I imagine you've done at least a client trip or two. You tend to every third, second or third week, I'd say. What has the investor or the client response been as far as how you've presented our material, but also how are they thinking about this? It's a really interesting point that by the time you get back to benchmark, just that alone could have a huge price impact. What is the very anecdotal, I guess, data that you can throw at me on that note?
That they are not capitulating. They are they're not adding to risk. They're not seeing this as a buy on dips moment yet, but they're not getting out of what they have either because, people think back to these events over the last few years. You think back to Liberation Day, where equities were down 20% and then recovered that within a month. And if you didn't get back in, you've lost out. You think about COVID, where we had the big collapse in equities and then we were back very quickly. So people are very wary of getting caught, getting whipsawed on that and not getting back in quickly enough. So no, they're not adding to risk. They're not seeing this as a buy on dips right now, but they're not getting out of what they've got either. And the price action being, yes, it's a slow bleed, but we haven't had that big down day. It's sort of encouraging them to keep what they've got, rather than reacting.
Yeah, I'd say it's very similar when you hear from and talk to clients in Europe. It's this, and it's a really good point about we've been through a pandemic. We've been through a shock to the terms of trade and the global trading system and lived through that. This is bad. Maybe it's not as bad as those. Maybe it's worse. As you say, there's no real roadmap here. We don't know. But I wanted to start to think about what your feelings are on the macro situation. We've talked investor sentiment, we've talked flows, but the actual nature of this shock and whether it will have lasting impact. I was thinking about the US and, US economic performance so far is not poor. Inflation is sticky though, and it's not to say the labor market is weak. It's just soft. The US is also not as exposed to oil as it was in, say, the 1970s when we had a big energy price shock and a hit to supply the way we're thinking about now. Does this really matter for the performance of the US economy? Are the sensitivities now so different that it is not necessarily something you can ignore, but something that you can look through quite easily when it comes to how growth might respond to this episode?
The interesting thing is, I know you want to take away from markets towards the macro, but the market is key for the macro here because we know about the K-shaped economy. We know that lower income, below 50th percentile income consumers are not the ones driving the economy forward. It's people at the higher end of the income spectrum. But that spending is largely being driven by a wealth effect. The wealth effect being from equities primarily. And so the real concern for the US economy would actually be, I don't think it's, look, oil prices are a drag, are a tax on the consumer. We know that. But it would really be if you did see the equity market crack and we saw, a 20, 30% down equity market, that's going to hurt the US economy because that wealth effect is suddenly reversed. And then you're going to get higher income consumers pulling back. And once they pull back in a K-shaped economy, then you have a problem. So it is actually the equity market that is key here, I think, for the US economy. If the equity market holds up, even if oil prices or gas prices, are around this level, but the equity market's okay, then the US economy is probably okay. But if we see gas prices go up and that causes equity markets to crack, then that's the big problem.
Is that mostly a consumption phenomenon, or are there downstream effects that are strong enough to actually worsen the situation in the labor market? And I ask that because exactly that point about the K-shaped economy that we have, is that a force that is powerful enough to really damage the labor market? Or is it maybe just a short-term consumption shock that results in a recession, but is the corporate sector, I guess, strong enough to weather that without massive job loss?
It's a really good question. I think it is to a degree. Look, we know the labor market is, as you say, it's softer, but it's a very strange labor market. The 12-month moving average for payrolls, I think, is 13,000 now, but the unemployment rate's only 4.4%. We've never had a 12-month moving average of payrolls down here without being in recession previously. So I think there's a big supply element to the labor market as well, which is holding down the unemployment rate, and jobless claims, for example, are very inconsistent with what we see in payroll. So I think that the labor market itself is soft. Is it fragile? Look, maybe, because if you see that drop in demand, that drop in consumption, that has to play into hiring plans, etc., for a range of different companies. The AI, the tech story should be fine through this, but maybe if you see demand reduced, then the excuse about laying people off because of AI, etc., that becomes more compelling for employers to think, well, look, AI is going to make a difference in a year or 2 years. If we're in recession now, I can lay people off now, and by the time the demand picks up, hopefully the AI element will have kicked in, and I won't need to rehire.
Fragility is the nice way to refer to it, I think. Actually, it is not necessarily that it's going to crack, but that all it takes is maybe a small shock to get it to crack. But
Exactly.
what's interesting to me in light of that is actually the response of the rate markets that we've seen over the last couple of weeks, which is basically taking out not all of the easing that was expected for the Fed and other central banks this year, but taking out quite a lot of it and actually starting to price tighter policy for some central banks who weren't expected to think about that until at least next year. I'm thinking of the ECB. The Bank of England probably wasn't expected to tighten policy for at least another couple of years. The textbook macro response is you look through this, it's an energy price shock. You just need to make sure there aren't kind of second round effects that push inflation expectations higher. But especially with a labor market that is at best fragile and potentially subject to further deterioration, what's your response to this reduction of easing that's been priced, or even indeed an addition of tightening? How do you respond to that?
With shock, actually, to be perfectly honest. I mean, you say we haven't taken out cuts. We actually have taken them out everywhere apart from the Fed. And there we had 2.5 cuts priced in for the Fed on the day before the conflict started. And we're down to one now. We actually put a little bit more back in this morning. We were down to less than one. The Bank of England, as you mentioned, there were nearly 2 cuts in for the Bank of England. We now have, what do we have? 15 basis, 60% chance of a hike this year? Look, I think these are ridiculous. I mean, I think, as you say, the textbook and what we've learned from central banks through history as an oil price shock is actually seen more as of a growth issue than an inflation issue. They target core inflation. They don't target headline for a reason, because they can't control oil prices. So what they target is core inflation. Does higher oil price have an impact on core? Yeah, sure, it does, but pretty small. There was a Fed paper that was written in 2024 looking at the impacts of the Russia-Ukraine oil price spike on the US. It found that it had something like, within 2 quarters, it was something like 6 basis points impact on core inflation. Much higher on headline for sure, but it reduced growth by about 15 basis points. And up until the last couple of days, the oil price impact for this conflict was very similar to the early days that we'd seen in Russia, Ukraine. What we don't know is from here, because it's now started to diverge because oil prices stayed higher for longer. Russia, Ukraine, they stayed elevated, but they sort of dropped back down. We're up about 20-25%, and we all got on. The Fed were hiking then. They did hiking, but not in response to that. This was 2022. This was when they were way behind the curve when it came to inflation. So I worry that people are looking at 2022 and going, aha, we saw the oil price go up and the Fed hiked aggressively from March 22 onwards. That had nothing to do with oil. That had to do with the fact that they were wrong about transitory inflation.
Yeah.
And so they had to react. But as you say, if we go back and look at it, the textbooks and what we've seen historically is they react to the growth issue, particularly the Fed, because don't forget, the ECB only has a single mandate. The Fed has a dual mandate. And we are going to see a change in the Fed in June. So whether the Powell-led Fed in his last 2 meetings cuts rate or not, probably not, given the uncertainty. But when it comes to the new Fed, I certainly think they're going to focus on the growth element. We've already had Stephen Myron was out on Friday saying that the Fed looks through oil prices. They always have done historically. I say the ECB is a different animal because they only have that inflation mandate, but even they always have an eye on growth. Bank of England as well, in theory, only have a single mandate, although because of the inflation range, you can say there's an implicit growth one in there as well. So I think the reaction functions of central banks will be different. I don't think any of them are going to hike in response to the oil price rise. You think about the two scenarios here, the two extreme scenarios, I guess. The one is this thing gets settled quickly, as seems to be the market expectation, I think. Quickly, oil price will come back down, maybe not to where it was, but it'll come back down. So in that world, the inflation fears subside. We go back to where we were, and where we were was, very different from where we are now. Worst case scenario, this thing escalates or this thing continues, oil goes to $150 a barrel. What are we going to focus on then? We're going to focus on growth. We're not going to focus on the inflation bit. Sure, headline inflation is going to go up a lot, but the central banks in a world of $150 oil prices, and probably in that world, equity markets are 20% lower, they're going to focus on the growth side of it. I was looking at G10 pricing. So actually, the day before the conflict, that Friday, the 27th of February, if you look across the G10, the aggregate pricing for rates for the next 12 months was a minus 47 basis points. Friday, just gone, it was plus 400. You've seen 450 basis points of hikes priced in, or cuts removed, hikes priced, whichever way you want to term it, which is, 45 basis points per central bank, which is extraordinary to me.
Yeah. It makes the dollar strength, given the Fed is one of the few central banks, as you mentioned, the only central bank that is still priced to ease, it makes the dollar strength all the more stark in contrast. I want to park that for a second, though, and just finish off the thought about the Fed. I mean, we really are only getting back to what the Fed themselves projected as far as rates and rate moves for this year. And I wanted to incorporate what you mentioned as far as the changing of the guard in June. You have a Warsh Fed coming in. You clearly have the same kind of divide of opinions that you've had the last 12 months or so, certainly since Trump's term started, on what to do with policy rates. I mean, what is your central scenario for what all that interplay allows the Fed to do by the end of this year? Is it actually cutting once and that's kind of it? Or I think before we were thinking they might actually be able to ease a bit more because, look, it's Trump's pick. He's victim because he's going to ease, et cetera, et cetera. But how complicated is that?
It's very complicated. I think the Fed cuts 3 times this year. That's where I am. That's where I was before this started. This is where I still am. Yeah. I think they cut 3 times. And because I think, as you say, Kevin Warsh has been put in to do a job, and that job is to ease rates. We can see the president is focused on the growth element, not the inflation element, by a Truth Social post last week calling on Jerome Powell to cut now, not even wait for the meeting. So he's obviously focused on the growth impact here. And I think that Warsh will be focused on that. We know that Waller is focused on that. He's focused on the labor market. We know that Myron is focused on that. And there will be others who will be sympathetic to the view that this higher oil price is a drag on the consumer and will lower growth in the future, and therefore we need to cut into it and look through it. And I think that Kevin Warsh will be persuasive enough. He can convince enough of the members that that's what they should be doing. And actually, in some ways, it actually probably makes Warsh's job easier, because there will be a difference of opinion there. But there is an argument to be made that we should be cutting into this, particularly when you've got payrolls payrolls that we've talked about the labor market, but the payrolls numbers themselves are poor. There's no two ways about that. So it actually makes his job easier if his job is to come in and convince the majority on the board or the majority of the FOMC that they need to cut rates.
So let's then talk and come back to the dollar, because everything you've talked about with respect to central bank pricing argues for a weaker dollar, and yet it has been obviously the star performer of this episode. There's a lot of reasons why it shouldn't be, and I think you've just articulated one, which is that the U.S. might, or the Fed might actually cut more than is now priced. But why is the dollar so strong right now? Why is it rallying?
Because the concept that the dollar is no longer a safe haven was always flawed. Safe haven status, I think, and what we've learned, what we should have learned, it's very event specific. I don't think there's a universal safe haven for every event. When it came to, Liberation Day, the trade tariffs, clearly the dollar did not act as a safe haven in a event that caused a big rise in volatility and sell-off in equities, etc. The dollar was not the safe haven because it was a US economic specific issue that was at the heart of it. When it becomes a global economic issue, a geopolitical issue, the dollar is still the safe haven. We've seen it before when people have talked about the dollar no longer being a safe haven, and then a geopolitical event happens and the dollar is a safe haven. Venezuela, actually, we saw the same thing, albeit briefly. When people rush to it, provides liquidity in uncertain times. Look, with a higher oil price, there's increased demand for dollars because it's the medium of exchange for commodities. So I think that is one of the major reasons. The other reason is because within G10FX, it was the biggest underweight out there. And if in times like this and people go back to neutral, go back to benchmark, that means by definition, you reduce the big bets you have on. And the biggest bet that people had in FX markets was to be short the dollar. So you have a currency that is still the safe haven for events like this. And at the same time, it's a currency where if you're collapsing back to benchmark, it's the one you need to buy as well. So you had a combination of those two factors playing into the strength we've seen in the dollar. Does this change the medium-term dollar downtrend? No, not in my mind, particularly as the Fed is going to be the one of all the G10 central banks that's most reactive in a dovish way to this because they have the explicit dual mandate. So I still think the medium-term dollar downtrend is in place. But for now, we are seeing a squeeze of those underweight positioning, and it is a viable safe haven that actually does give you yield in cash, relative to most, not all. In G10, it's still a relative high yielder at that 364, the effective rate right now. Why shouldn't the dollar rally in this world? Once we get through it and we focus on, monetary policy afterwards, we know what's going on, then the dollar downtrend resumes. But for now, it makes perfect sense for it to be the safe haven that people are running to.
Well, it's actually interesting because today is, as we record this on Monday of this week, the dollar has started to come off its highs. It was the DXY, the dollar index, was butting up right against the top of the range that it's had, I think, for about 6 or 8 months now, and was looking to break through, but has not done that. What then is the risk reward here? Is it that safe haven demand does break that range? You get a little bit more of, the pairing of the underweight that you mentioned, which I think is a key factor. Is that the sort of path of least resistance right now? And if so, at what point do you think it becomes advantageous to think about selling it? And then the part two of the question, I always have two-part questions, is what do you buy against it? Carry and commodity currencies and EM carry, especially, I should say, have been really popular choices. What do you go back into as an alternative to the dollar, and when?
I mean, you come back to the question we've had all the way through this podcast. How does this play out? Do we get a settlement in the next few weeks? No, it drops down to $90 or $80 or just carry on and we go to 150. Until we know the answer to that question, I don't think it's the right time to fade the dollar move. The underweight is still significant. We see no sign of any slowing in the buying. 5-day flows are 97th percentile. The last 5-year history is the strongest since March 2024. The underweight is still the biggest in the G10. I'm not sure I want to chase it here, though, by buying dollars today. I guess that's where I am now. The opportunity to buy dollars was a couple of weeks ago. I'm not sure I want to chase it here, quite honestly. And maybe that's wrong, and you will see some more dollar gains. But yeah, I think you've seen the majority of the dollar move. I'm not sure it's going to reverse yet. You have the tail risk that this thing really accelerates and you get more dollar safe haven buyings and say the underweight is still there. So I don't want to chase the move, but I don't want to fade it, which is sort of, I'm sitting here not doing a lot right now on that basis. But look, this is what this is where everything is pointing. This is what people are doing. They're sort of, I'm not adding to risk. I'm not buying on dips. I'm not getting out of what I've got. I just want to see how this thing's going to pay out. And it goes back to, right at the beginning, this slow burner. We don't know. We haven't had that Lehman moment. We haven't had that one-day collapse where you can go, okay, now we can have a look and say, this is the time to buy. We're not there yet. When we get some sort of resolution, it's the time to sell the dollar. What would I do that against? Yeah, I probably would look at carry again. I would look at EM again. Policy is doing a lot of things right now, whereas G10 isn't. So I still think there's a long-term pro-EM carry trade out there. It's just you can't do it right now.
Okay. Well, on things that we are going to do right now, we're going to wrap, and I'm not going to ask you to be any more generous with your time than you already have been. Lee, as always, lots of insight and a pleasure to chat. Until next time.
I would look forward to it. Thank you.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. This communication is provided by State Street Bank and Trust Company, hereafter referred to as State Street, and is for informational purposes only, and is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.